Hello, welcome to Be the Boss of Your Money. I'm Mitch Goldberg, your host. This is my live stream that I run every Monday through Thursday at 4:30 p.m. It's all about personal finance and investing and banking and all kinds of questions that you may have. And we go over the latest and greatest, not just in personal finance, but investing strategies, legalese, accounting, that sort of thing. So we want to cover it all, but ultimately it's about helping you become better with your money, answer your questions, your investment questions. We get into current topics like Bitcoin, GameStop, and sometimes we get into politics as well as it relates to your personal finance, your tax rates, and other things that could impact you. Today's live stream is all about looking for danger in the stock market. It's been an incredible rally for the stock market. The rally we're in started late last March of 2020. It's almost a year, and things clearly have done way better than people expected. And as bulled up as I am, and I've given you my base case scenario, which I will repeat right after we run the quick intro video, but I want to get back into that and let you know that just because I am at the moment pretty bulled up on both the economy and the stock market, that doesn't mean I'm always going to be right. And it certainly doesn't mean that we should stop looking for the negatives to make sure that we keep a lid on our own enthusiasm. So let's take it to the quick intro clip. I'll be right back. This is going to be good. Welcome back. I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money, but I really should call this your live stream. So if you're watching this right now in the live stream, if you have any questions about the topics we're discussing here or personal finance, investing, let me know what the question is in the comments so I can give you an answer. To me, that is the best part of doing this, is having interaction with you. I love answering your questions. If you're watching this in the replay, I'd like to welcome you as well. Certainly ask me any questions that you may have in the comments. I will be monitoring for more questions, so they will not get away from me. And I'd like to welcome everyone who's right now watching Be the Boss of Your Money. So the question right now is, what could knock the market on its keister? It's been one heck of a run. And yesterday we had basically all new records in the major averages. And as bulled up as I am, and I've given you my my base case scenario, what I don't want to do is get carried away with boundless enthusiasm and set myself up for a major disappointment, nor do I want to set up my clients for a major disappointment. No, we don't want to do that, because, my clients are the lifeline to my livelihood. It's a direct relationship. Take care of your clients, they take care of you. That's what the relationship is all about. So let's just go into a couple of things. My base case scenario, I want to repeat this, it has been, if you're a watcher of this live stream, the base case scenario has consistently been, we have a very strong economic rebound in the second half of 2021. I've been saying this now for months. I know now it's a very popular base case scenario, but that's been my base case scenario before it got popular. And I'm sticking with that. Between all the stimulus that's already come out and the new $1.9 trillion stimulus that looks like it should be out, approved through reconciliation over the next couple of weeks, that is going to juice up the economy, I think, big time. There's going to be so much money in the system, and money that actually goes into people's hands. Almost all of that is going to be spent. As a matter of fact, over the last couple of months, the Purchasing Managers Services Index, the service part of the economy, has been doing quite well, even with the movie theaters and the restaurants and amusement parks shut down. The manufacturing part of the economy has been doing well. There were a few things holding it back, particularly a shortage of semiconductor chips. There's a pretty big shortage of chips, and it's actually impacting a lot of heavy industrial machinery manufacturers. It's impacting Ford and General Motors. It's what happened is when the pandemic started, companies cut back on production, components manufacturers cut back on production. And now that things are heating up again, its production has to actually ramp up again. So that is one thing, but that's not a bad problem to have. Okay, I'll tell you this: there are worse problems. You could have too much capacity and not enough demand, which would really just be the worst thing that the worst economic situation that you can have. So the base case scenario is that also we're talking about stimulus, but as we get more people vaccinated, not just here but throughout the developed world, hopefully the rest of the world, but especially in the United States, as more people are vaccinated, that gets people back to traveling, going back to work, going back to their offices, restaurants, etc. It's just a really big economic pickup. In the meantime, corporate America has learned how to do more with less. In particular, less expenses, but less labor. But that shifts. Now, the companies that cut back on labor are going to be very hesitant to bring back all their labor. So what happens is companies start to raise prices because of so much demand and not enough supply. And that creates a cycle where companies do start hiring, they do start raising prices. And since companies learned how to operate with less revenue, their expenses are lower. When their revenues go back up, that's a real boon for something called operating leverage. So operating leverage is just a massive force on earnings that could drive companies' profits for a long time. Now, the fly in the ointment is that if the economy is doing so well in the second half of 2021 and 2022, I expect, the street expects, and this has been my base case again for a long time, I expect inflation to pick up. Now, the Federal Reserve, who has the charge of short-term interest rates, has said that they don't plan on raising rates probably through 2023, maybe even later. And they also said they won't just look at a few months of 2% plus inflation. That's kind of their bogey. The Fed wants to see 2% plus inflation. But they said if it goes above 2%, if inflation goes above 2%, they're going to look at a long-term average, not just 1 quarter's worth of figures. Okay. So that is pretty significant that the Fed is willing to let the inflation horse out of the barn, so to speak. But if inflation is too high, and we don't know what too high means yet. Maybe is 2.5% inflation too high? Is 3% inflation too high? Okay, we don't really know what the inflation means yet. That we don't really know what too high of an inflation rate means yet. So maybe it's 4%. But at what point does the Federal Reserve say inflation is too high and this is becoming a sustainable level of inflation? And then what the Fed would do is the first step they would take is they would taper their $120 billion of bond purchases every month. And then after that, they would start to raise rates. Now, when they start to do that, will the economy have enough steam, enough velocity to outrun a pullback in help from the Federal Reserve? That's that's the $64 trillion question. That's the question that everybody needs to know. So that's the number one thing, the number one danger to the stock market. Okay. And that's a danger that we'll hopefully see well in advance. Now, if corporate earnings are continuing to be so strong and the economy is continuing to be so strong and the inflation rate creeps up so much slowly, I think the stock market can handle a tapering of bond purchases by the Fed and slightly and higher short-term interest rates and higher long-term interest rates. Not much higher, but higher. Again, we don't know what the terminal rate is for the Federal Reserve. That means what the Federal Reserve sees as the final Fed funds rate. Is it, they're at just about zero? Is it 2%, 3%, 5%? At that point, at the highest point they get, that's the terminal rate. We don't know what that yield is going to be. So that's the number one thing that could hurt the market. The next thing that could hurt the market is if companies, if stocks, let me start this again. The next thing that could maybe hurt stocks is if stock prices have gotten way too ahead of corporate earnings. And in some cases, even when a company has an amazing earnings and revenue report, sometimes companies get to a point where investors deem it as not good enough. And that's like, that does happen occasionally. I'm going to punch up an example. Hopefully I'll be able to pull this up quickly. Okay. If you take a look, for example, at Zoom, we all love Zoom. Like, I don't know if we all love Zoom, but we all know about it. I know some people who are so sick of Zoom calls that they can't stand it anymore. But by the way, I put out a post on LinkedIn about how to improve your Zoom calls and how to make it better for you and for everybody else. And if we all follow these 6 steps that I outlined in that LinkedIn post, we would all be much more satisfied with Zoom. One of the reasons that people are exhausted after a half hour to an hour Zoom call is because most people who are on a Zoom call are using lousy audio and lousy video. They're using the built-in webcam in their laptop, or they're using the audio, just the mic that comes with their laptop or their webcam, microphone. And what happens is it's poor audio, poor video, and your brain has to work harder to process what it's seeing and hearing. And because your brain is working harder for that, it actually makes you tired. Because you could watch a clear TV with good audio for a few hours and be fine. But if you took an old TV with lousy audio and lousy video, after about 10 minutes, you'd be like, oh, I just can't do this anymore. Okay. So that's how that happens. So anyway, Zoom video. The stock was 588. It's now 430 on today's close. That's a pretty significant drop. And Zoom's earnings have been phenomenal. Now, maybe Zoom will zoom right back up. No pun intended. That's not the point. The point is that sometimes companies can report, for example, 100% growth rate in earnings. And it's still not good enough because now the stock is priced for 200 or 300% growth rate in earnings. So at one point, the price of a stock could get ahead of its earnings growth. So that's another thing that we have to, watch out for in the market. Another thing that could knock some stocks down. And typically that'll happen with the high flying stocks, the stocks that have been leading the market the most since the bottom of the, bear market from last March. Okay. So that is another thing. And another thing that we always have geopolitical events, but I don't want to get into specific geopolitical events because you never know what they are going to be. But there's always something called a black swan. A black swan event, like a pandemic, is something that is pretty huge, something that we can't really foretell. And even if we get a glimmer of what it is, we usually can't tell how big or destructive it'll be. Another example would be if, let's say, it, okay, an, another example could be if the Great Recession, when the subprime market started to crumble in the beginning, the Secretary of the Treasury, Hank Paulson, came out and said, we don't think this is a problem. We'll weather this just fine. It's not going to impact the market. There's not a housing bubble. The rest is history, and we saw how bad that was. So there is always the potential for a black swan, and the problem is you could never really tell when it's going to hit you. So that is the thing with a black swan. We have a comment or a question out here. Let's just take a look at this. Okay. Let's see. Audiovisual should not be an impediment to having a conversation. Right, you are, Ron. Ron, you are the expert. You know what? You and I need to actually speak by phone because I feel like we're fast friends. You are my audio video brother in arms. Thank you very much, by the way, for commenting. I appreciate that. So so those are the key things that I think could knock the market down. I'm going to put aside the black swan event, and I'm going to leave in if inflation picks up too much the second half of this year. For example, oil is almost $60 a barrel. What if oil goes to $80 or $90 a barrel? Stranger things have happened. During the Great Recession, when Lehman Brothers went out of business, right around that time, oil per barrel went to $147 a barrel, and that freaked people the heck out. So stranger things have happened. So inflation, rising oil prices, it has a lot to do with inflation, of course. That's why I bring that up. And then again, if corporate earnings get too far ahead, or if stock prices get too far ahead of corporate earnings, that's the second fly in the ointment. How do you handle this? If you're investing in broadly diversified investments, ETFs, a lot of passive investing, and you have a pretty long time horizon going forward, there's really not much to do except keep investing, invest regularly, rebalance, and keep going. Because like Warren Buffett once said, if you think the stock market's expensive today, wait until you see how expensive it is in 20 years. I love that expression. It just hits me, and I repeat it often. So what I want to instill upon you, if you are in individual positions and you've built up a lot of individual stocks, you've got some, I'm just going to throw out some names, some DoorDash, some Facebook, some Amazon, some Zoom, some DocuSign, some Tesla, what the high flying stocks are. And I'm not saying there's anything wrong with them. No, I'm not. And there's no judging here. These happen to be amazing companies that have done amazing things that have enabled us to actually work from home and be productive during a lockdown, during a pandemic. And I don't think what's going on now is going away. We're not going back to 2019. I don't know if we're going to stay full on Zoom calls and video like we are now. I don't think that, but we'll be somewhere in the middle between 2019 and, let's say, where we are now. Is it in the middle? Is it more to the left, to the right? It's really, closer to 2019, closer to 2021, maybe 2022, if we could look that far out. It's tough to say, but we're not going away. We're not going back. This whole video conferencing thing. All right. So, but if you're in individual stocks, and if you recall what happened to individual stocks in the year 2000 during the tech wreck, that was a disaster for a lot of, during the tech wreck was a disaster for a lot of individual investors, and a lot of high flying tech stocks. Not only did they go down, they stayed down. Now, the current crop of tech stocks, in my opinion, is way better than it was in 2000. I mean, early stage, everything in 2000 that went public, late stage, everything that goes public now, really highly developed businesses. And if you take a look at it, I know I'm going on here, but I want to give you like the best example. Amazon versus Barnes & Noble. Now, Amazon started selling books, And Barnes and Noble decided, oh, okay, we'll have to compete with selling books. So Barnes and Noble becomes barnesandnoble.com selling books. But why did Barnes and Noble lose so badly to Amazon? Because Barnes and Noble made the mistake of becoming a bookseller online to try to imitate Amazon. What Amazon did is this: it was never about books. Books was just the first thing. What Amazon was doing was spending money to build a platform where anything could be sold. But what Barnes and Noble did is they thought, well, we just have to compete with books. But you can't buy lawn furniture from Barnes and Noble. You can't buy a camera from Barnes and Noble. It's not a platform. They don't have Barnes and Noble web services like Amazon Web Services. Barnes and Noble viewed Amazon as a bookseller, and a lot of investors viewed Amazon as a bookseller, and the stock went from like 100 to 7 during the tech wreck. And today you look at a stock like Tesla. I just want to say I don't have a position personally in Tesla. Okay. But so I just want to say that, and I want to give you an idea of why Tesla is so highly valued. When you look at Tesla as an auto company, it's so overpriced. It's so ridiculously, outlandishly overpriced. It's incredible. But when you look at Tesla as a platform, not just cars, but electricity, electric generation, batteries, solar, it's a platform where a lot of things could be delivered. DoorDash. Is DoorDash just about food service? Because now, like we use as a family, we use DoorDash all the time from things at Walgreens or CVS. It's not just a food delivery company anymore. DoorDash is now a platform where you could get anything. Food was just the entree. And if Grubhub and Uber Eats are still competing with DoorDash based on being a food delivery service, that's why they're going to lose. And that's why DoorDash has the valuation it has. Airbnb. Is it just about renting houses or, short stay vacation houses, that sort of thing? Or is it a platform? And that's what I think we're discovering. The street loves a good platform. And I think that's the biggest difference between today's high flyers and what companies were doing in the tech wreck. So there you go. If you're broadly diversified, markets tank every now and then, and they recover. If you are in a lot of individual stocks, just be prepared that you could be in for a wild ride. You could be kicking yourself and say, why the heck didn't I sell when I had like these huge profits? Why was I being so greedy? You could be like that, and then they could come back. But you are at risk of some of your individual stocks going down and not coming back. You have to decide what's best for you and how you want to mix it up between individual stocks, funds, and exchange traded funds, mutual funds, and other investments. Okay, so that's my story. I'm sticking to it. I hope you found this useful. If you have any questions that you could think of after this live stream, certainly hit me up in the comments. I'll be on the lookout for those. And I thank you very much for your time. It's very valuable, and I appreciate you spending some of it with me. All right, see you tomorrow. Thank you.